Good evening, everyone. Welcome to the finance webinar session of IIM Rohtak. The session would be conducted by Rishabh Jhunjhunwala and Yukti Jain. Rishabh is a graduate in BBM from Jain College, Center of Management Studies, Bangalore, and Associate Financial Planner in Investment Planning. Yukti Jain is BCom Honors from Lady Shri Ram College, Delhi University, and she has cleared CFA Level 1 and FRM Level 1. First of all, I would like to congratulate the participants for making the next stage of CAT selection process. The first half an hour of the session would be dedicated to the webinar, and the next half an hour would be dedicated to question and answers. During the session, we would cover the basics of finance, and let us try to maximize our learning during the session. So now I would hand over to the Rishabh.
Good evening all. Congratulations for making it to the next level. Today we shall discuss about the basics of finance. We would like to try to give you the basic foundation in the next half an hour, and then we would take up the questions. Okay, what are we covering up today? Today we would cover up the general accounting that pertains to any business organization, derivatives, that is forwards, futures, options and swaps, and we would also include the cost of capital, which includes cost of equity as well as cost of debt. Okay, let us go to the financial accounting definition. Accounting is the art of recording, classifying, and summarizing in significant manner and in terms of money transactions which are in part at least of financial character and interpreting results thereof, as per AICPA. Okay, now we would move on to the basic accounting concepts or principles. Firstly, going concern. Now, for any business that is started, the objective of any business is to go on for an indefinite period. If an entrepreneur or a company is established, the view of any person who starts it is that it will go on for an indefinite period. Suppose a company buys a machinery for 5 years, then that doesn't mean that after 5 years the company would stop its operation, but rather the company would replace a machine after 5 years. Now let us move on to accrual basis. As per accrual concept, it states that all the transactions, there are two kinds of basis of accounting. One is accrual and one is cash. As per accrual concept, expenses are done, but not yet expenses.
We recognize the revenues and expenses when they are due and not when they are paid or received. So
I would like to give an example. Say, if a consumer buys goods on credit. Now credit here means that he is purchasing the goods but not paying immediately, cash immediately. So as per accrual concept, we record this as a transaction. But as per cash basis, this transaction would be recording only when the cash is received. Next, we move on to the business entity concept. This concept is very clear. Business and an individual are two different entities. Any transaction that has been taking place in the business will not reflect an individual and vice versa. Let me give you an example. Say if a person is buying AC for his house purpose, that money would be, if he uses that money from the business, that would be considered as drawings. Whereas if a person buys, say, a refrigerator or a car for business purposes using his own money, then that would be traced as introduction of capital by the entrepreneur if business uses it. Next, we move on to money measurement concept. As the name suggests, money measurement is clearly tracing that any accounting transaction has to be in terms of monetary value. Only those transactions are recorded which are measured in terms of money. Now, say for example, an employee is very loyal to the organization, but loyalty cannot be measured in terms of money. But if you are buying, say, assets of a firm or machinery, its value can be traced in terms of rupees. So Money measurement just traces the concept of a concept that anything that a business buys should be in terms of monetary value. Conservatism principle. As per this principle, business tries to forecast and provide for all losses before. Now, say what happens in a business. I can forecast a profit of 50,000 rupees in the near future. But if there is a possibility of 20,000 loss, then the business would provide for that loss, even if there is a slightest chance. That is, in all the books of accounting, you would first show all the possible losses. You account for all possible losses when you're giving your financial statements. Now, the concept of duality. As per this concept, any business has any transaction that takes place has two aspects, a debit aspect and a credit aspect. We follow the dual system of accounting because, say for example, a business buys goods on cash. So the dual aspects are, one, the business is buying goods, so that becomes purchases, and the second thing is that business is paying through cash, so cash is another aspect of it. Now we move on to the accounting process. What happens? Initially, an event occurs which leads to a transaction. If, if there is an event but there is no transaction, then it is not under accounting process. Say for example, an event example could be that you go to a shop, you bargain and you don't end up buying, then that doesn't come under accounting. But if in case you end up buying, then that leads to a transaction. Now a transaction is firstly recorded in journal. Journal, again, say journal is a kind of an entry that is given by an accountant which shows the dual aspects of the transaction. Let me give you the same example that I gave in the previous slide. If a person buys goods on credit, or if a business buys goods on cash, then say for 20,000, then the entry becomes, journal entry becomes purchases account 20,000 debit to cash account credit. Further, journal moves on with ledger. Then we post the totals of ledger to trial balance, and then we move on to final accounts. This is the general accounting process that is being followed. Now we would move on to profit and loss account. The business, a profit and loss is a statement of profit or loss. We also call it the income statement. It records all the incomes and expenses during the quarter or a year. It provides exactly what the company what has been the revenue and what has been the cost of the business. The top line is the revenues are also called as top line, and the net profit after tax is called the bottom line. Now you can see in this slide, number one, which says revenue from operations gross. This is called the top line. And number 9, that says profit for the year, that is called the bottom line. This is a general statement for profit and loss, and also called as an income statement. As you can see here, it first records the income, the net income, and expenses are deducted to get profit. Then later, tax expenses are taken out and the profit after tax, that is the bottom line, is calculated. A profit and loss statement only measures the profitability position of the company. Its basic objective is to just see the growth of a business in terms of profit. Now we move on to balance sheet. Balance sheet has a couple of aspects. One is the assets and another one is the liabilities. Now when a business is started, they need to organize the funds, which we call sources of funds. Some sources, common sources are equity capital, reserves and surplus that includes the past retained earnings or the extra reserves that the company has created, like the general reserves or transfer to reserve fund. Surpluses are anything that is left over, the profits that are left over from the business. Preference share capital. Preference share capital can also be called as a hybrid security. It has both the aspects of equity as well as debt. A preference share is generally issued to people who do not want to take too much risk in the business as well as keep some portion of profits of the business. They are usually redeemable or irredeemable. In India, we always have redeemable preference shares. Now we move on to long-term loans or debt. A debt is a certificate of a borrowing. Usually, companies borrow from outsiders, which may be banks or general public. When they borrow from bank, they are called term loans. When they borrow from public, they may be called a bond or a debenture. Then we move on to short-term loans. These loans are usually less than 1 year. Short-term loans are usually taken for working capital. Working capital means that business requires to run on a day-to-day basis. So to cover all the expenses, business needs to have working capital, maintain working capital. So short-term loans are taken for that. Current liabilities and provisions. A business has some day-to-day liabilities like bills payable, creditors. A creditor is someone who the business owes money to. Now we move on to assets. Once you have gathered the amount, you need to apply it into any business area. So we have long-term assets. These are fixed assets that are being used by the business. Something like land and building, plant and machinery, and so on. So these are usually taken by the business for the reason of generating profits. They are not taken for the reason of selling in the near future. The business operations are carried out through these fixed assets. Talking about investments. Whenever a business has surplus cash, to utilize that fund in generating some income, businesses use investment as a tool of generating some revenue. These revenues that are generated from investments are classified under other revenue as they are not part of the operating expenses, operating profits of the business, operating incomes of the business. Now we move on to the current assets, loans and advances. This covers inventory, cash, bank, etc. Now when we talk about inventory can be comprised of four things. One is the raw material. Then we have raw material is the goods that are directly purchased from a producer or a manufacturer. Now this goods, when is into a process and still not converted completely, that is known as work in progress, inventory. Then finally we come to the finished goods. Finished goods are some things which are completely, which the business completely finishes once all the processes have been undertaken. And finally, there are some elements which are important, which may be classified under other loose tools. Like say for example, when you're making a table, sometimes you do not see Fevicol or nails and bolts used. Those are other components of inventory. Now we move on to other current assets like cash and bank. Cash is the usual cash in hand with the business, and bank is the amount that a business has at the bank. This is the structure of a balance sheet. Firstly, equities and liabilities. These are the sources of funds, and the assets are your application of funds. Let's move on. Now I would like to tell you the types of capital. As I already said, some of them I mentioned earlier. I would retrace some of them again. Equity share capital. An equity or a person investing directly into the business is known as equity share capital. The characteristic is that he bears the risk of business operations. Anyone who pays money and expects that the business would return him and interest would be paid on it would not be an equity, but it would be a debt. So equity clearly means that the amount that a person pays for running of the business um, when he assumes some part of risk with the company. Preference share capital, as I already said, is equity plus debt. That is the hybrid security. Reserves and surplus, I have mentioned in the previous slide. Now we come on to some of the short-term loans. Bank overdraft. This is a facility that a bank gives to current account holders. Any business that is operating needs to have a current account. This facility is that usually a business can borrow or spend an amount more than they have in their account. Say for example, a person has 50,000 in his bank. He can spend up he can spend up to a certain limit. So for example, if there is a transaction of 70,000, so business can pay 70,000. That is, he will have negative 20,000 in his bank, which is also called the bank overdraft. Interest would be charged on this particular amount for the amount of days that he holds. Credit limit.
Um, Credit limit is a working capital loan which is given uh, to the to the people, to the company or the business, and I'd like to take you through the various types of share capitals. As Rishabh had mentioned, there's equity share capital. This is taken from the annual report of C8 Limited. So C8 has an authorized share capital of rupees 60,000 lakhs, and the breakup is given as you can see. So out of these authorized share capital, they have issued just uh, 3,424 lakhs of the equity share capital. Also, the second source was reserves and surplus, which is the retained earnings of the business over the years. So that is also used to fund the finances. Preference shares, they have authorized, but they aren't using. Long-term loans, so long-term loans, borrowings can be from bank, as you can see over here, or they can be taken as in form of public deposits, which is unsecured, or it can be a debenture, as discussed before. Short-term borrowings, again, they can be unsecured or secured. Short-term is also either a public deposit or from banks. So this is how it is. Now we come to cash flow statement. Cash flow statement has three parts basically: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So, what is cash flow from operating activities? We are trying to see what is the cash generated from operations. So, how do we get to that? We take the net profit for the year and we adjust it for the expenses which we have taken in our profit and loss account, but they weren't paid in cash, like depreciation. It isn't paid, it's a non-paid expense. So, and the other incomes and expenses which are not related to our operations are also removed from here, like interest income and dividend income, which is our income from investing activity. So also we adjust for the working capital changes. Working capital, as mentioned before, is investment in inventory, trade receivables, like current assets, like you can have accounts receivable from debtors, and trade payables is which you owe to the your creditors for purchases or any expenses. So we adjust our working capital for our cash flow from operations for these working capital changes to get the net cash generated from operations. For cash flow from investment, we take into account the fixed assets purchased or sold during the year, and we take into account the investments made, which are in companies or other securities, and the return on these investments which were made that have been received. Cash flow from financing activities, it consists of our loan interest payments and dividend payments and loan payments, or what we have issued maybe equity during the year. So this is how we get cash flow from financing activity. Next, we move on to the ratios, which are used for analyzing our final accounts, which was profit and loss account, balance sheet, and cash flow statement. These three are analyzed using these ratios.
Liquidity ratios. Liquidity ratios measure the liquidity position of a business. They are of two kinds. One is the current ratio and another one is a quick ratio. The application of liquidity ratio is knowing the availability of cash or current assets in the business. That is, how much a business has current assets with the in in comparison with the existing current liabilities. Now we move on to activity ratios. Activity ratios are ratios that measure the efficiency which a business uses its assets, such as inventories, accounts receivables, or fixed assets. Now, when a person wants to know how efficient his business is, he may use a few ratios like fixed assets turnover ratio, inventory turnover ratio. Now, say for example, he uses fixed assets turnover ratio. If the company has a fixed assets of 1 lakh and has generated sales of 3 lakhs, then its fixed assets turnover ratio would be sales by total fixed assets. That is 3 lakh by 1 lakh, which is 3. 3 is to 1. Now we move on to debt ratios. These measure the solvency position of the company, how much a company is leveraged, and what component of portion is in equity and what component is in debt. Some of the common ratios are debt equity ratio, total asset to debt ratio, or proprietary ratio. These ratios are commonly used for checking the solvency position when a company goes in for a loan or any other thing. These ratios come in handy. Profitability ratios. These are these measure the profitability of the business and how efficient or how much, what part of profit is coming from where. Say, gross profit ratio measures what are the total factory costs. Eliminate revenue minus all your factory costs or all your operating expenses, give gross profit, which is divided by sales and gross profit is arrived at. Similarly, we have other ratios like EBIT margin, net profit ratio, EBITDA margin, etc. Market ratios.
Market ratios would cover our dividend per share, dividend yield, price to equity, price earnings ratio. Sorry. So what these ratio indicate? These ratios map our book values to the market values of the share. Like price earnings ratio is a very popular market ratio, which is market price per share upon earnings per share. So you can analyze that how much is the ratio of the earnings to market price. Next is derivatives. So what is a derivative? Derivative is a financial contract which derives its value from another underlying asset or index or interest rate. So there are four classifications which we have covered: futures, forwards, options, and swaps. So what is a future? A future is a standardized instrument which is traded on an exchange, and what happens is like suppose what is a derivative basically? Suppose there's a farmer and he anticipates that after 3 months the price might fall. So he wants to hedge his price risk. On the other hand, there is a miller who wants to buy the wheat from farmer, and he anticipates that the price might rise, so his cost will rise. So they both want to lock a price for a future delivery date. So this is the basic functioning of a derivative. So they are basing their contract on the basis of wheat prices today, and they deliver this in future. So this is a forward, because it's a forward if it's over the counter. If this is done through an exchange, it would be a future contract. So in forward, there is high credit risk, but which is basically mitigated uh, because the companies which are entering into forwards are generally having low risk. So because of their reputation, the risk can be mitigated, but it's a general perception that futures, because they are traded through an exchange, have lower risk than a forward in credit risk. So next we discuss options. So there are two types of options: put option and a call option. And a put option is like you're getting a right but not an obligation to sell the security at a specified price and within a specified time. So there are two types of options. This is applicable for both put as well as call option, European or American. So what's the basic difference is European can be exercised only at the due date, which is the maturity date, and American can be exercised during the whole duration. So a put option will give you a right but not obligation to sell at a particular price, and a call option is right but not an obligation to buy a stock. So basically these options, if suppose you have a stock and you anticipate that the price right now is high and you want to lock in the price, and uh, you want after X period, maybe say 1 month, you should have the same price. And if the price falls, you can get a guaranteed price using a put option. And call option, if you anticipate that the price will of the stock will rise in future, and you want to buy the stock 1 month later at the price today, maybe you can use a call option. So now we come to swaps. What is a swap? Like you are exchanging certain things. So interest rate swap is maybe you are getting a fixed rate of return, but you want a floating rate of return. So you'd find a counterparty who is getting a floating rate of return and is willing to get a fixed rate of return. So you would enter into interest rate swap, which is also known as plain vanilla swap. So what you'll do, you'd pay them you'd pay them a fixed rate and instead get a floating rate. Currency swap. Suppose you are in India and Mr. X is in America. He needs rupees and you need dollar. You want to invest in America. So you'd enter into a contract with Mr. X to a currency swap wherein you both will exchange the notional amount, the amounts you want, and also you decide upon the interest rate. Both the interest rate will vary because of the differences in currency, and it would be a long-term currency swap which you'd enter into. Commodity swaps, they are generally entered like they are on the basis of an underlying commodity. For example, oil price. Suppose there's a producer of oil who wants that over the year he might produce oil and he wants to receive a fixed payment instead of the fluctuating oil prices. So he'd enter into a commodity swap with a person who wants to pay fixed payments, and this way a commodity swap would function. Credit default swap. Credit default swap is basically an agreement between, like, you're hedging your credit default risk. So it's a kind of insurance, but you need not have an underlying asset. So there's a spread which you have to pay for the default of the asset, and like you generally uh, earn if the spread increases, and in case the company defaults, then the person who has sold you the credit default swap is liable to pay you. And this is about swaps. Now we enter into cost of capital. We are studying cost of capital from a valuation point of view. So, how would you compute cost of equity for a valuation perspective? There are three basic models. One is dividend discount model, and capital asset pricing model, and factor model. So, how do we compute cost of equity? It would be dividend to be paid under dividend discount model, dividend to be received at the end of the year upon the price at the beginning of the year, plus the growth you expect the company to have over the years in long run. And what is capital asset pricing model? You take the risk-free rate plus beta, which is a sensitivity index of the sensitivity of the stock to the market. So it's a index for systematic risk. I think this is getting too much of you might not be required, but just to give you an introduction, we thought that this would be good. Cost of debt is equal to the interest rate into 1 minus the tax rate, because debt for the company, it's a tax deductible source, and cost of preference shares would be dividend to be paid on preference shares would be plus majority value minus net proceeds upon 50% of majority value plus net proceeds. And using all these, what we want to compute is weighted average cost of capital, which would be weight of equity into cost of equity plus weight of debt into cost of debt plus weight of preference shares into cost of preference shares. This is from us. We'd like to take up the questions now. So our first question, which we want to take up is, we won't be answering the questions related to economics because they would be taken up in the near future in the economics session. And the first question was, what is equities by Dipanshu Malhotra? So, as we told you, equity is the owner's fund, which is invested. So, it's like equity. It can be equity share. So, it would be the investment by the owner, and
Say, what is equity now? If you invest, say, an amount of 50,000, you're starting a business of 50,000, and you invest your personal money into the business, that 50,000 represents equity. That is, you are taking the risk to run the business. Now, equity can be, these are usually, for a company's angle, these are equity shares. A person may have equity, just one equity share. That means he represents the risk bearing. Suppose if the share price, face value of the share price is 10 rupees. So he is given that 10 rupees and assume a risk of rupees 10 to that company. For any profits that the firm gets or the company gets, he will be given dividend, or this would, the price would affect his share value.
Uh, another question was difference between gross and net income. So I'd like to tell you both gross and net revenue as well as gross and net income. So what was the difference between gross and net revenue? That is basically the taxes, direct taxes to be paid, the duties and excise duty, except import duty, etc. So that would be the difference between gross and net revenue. Difference between gross and net income, that would be like if we subtract just the
Gross income is when a business has its net revenue subtracting all the factory related expenses. That is, in electricity of a plant, or any other expense, direct expenses which are related to the business. Those are usually factory related, like fuel, power, etc. Labor, direct wages that you pay in the factory. But the salary that you pay for official work will be deducted from, is not a part of gross profit. It will be deducted further, and that becomes a part of net profit. So any expense, that is administrative expense which is related to office, or selling and distribution expenses that facilitate the smooth marketing of your products, comes is subtracted from gross profit to arrive at net profit.
Next is what is the difference between bonus share and share split? So bonus share, it's when a company issues a share on your existing shares. So it is out of the reserves and surplus of the company. So what happens in bonus share is like for every one share held, you're giving maybe one more share. So that would be a bonus share. Share split would be when, suppose if in the books of the company a share has a face value of rupees 10 per share, and you are splitting the share into two. So your share, one share would become two shares by splitting the share, and the the book value per share would be also split. Like it's rupees 10, so it will become 5 per share. You're not using your reserves and surplus to issue the share split. Next was is this much of accounting knowledge required for interviews? So we believe yes. Like it might not be required, but if you know, it's always better. So you're hedging your risk.
Secondly, there are some commerce graduates and science graduates. It is expected from a commerce graduate to know their 11th and 12th basics well, and further any finance courses that they have taken up. For engineers or any other stream, you are expected to know the basics of financial statements, like what does a profit and loss statement tell you, a balance sheet tell you, or why is a cash flow required. Say cash flow is required, as you might be aware that there was a scam, Satyam scam. So these scams can be detected through the cash flow statements. It is a tool which actually shows the inflows and outflows of cash or movement of cash from a business.
Next question is by Yash Anuja. What is the difference between normal equity share and preference share? So a normal equity share doesn't have a like the dividend can be anything. For a preference share, it's a generally specified rate of return. Like it would be 9% would be the dividend on the preference share perhaps. Also in the risk aspect, preference shares are less riskier than equity shares. In case of liquidation of the company, preference shares would be paid before equity shares. Like they would be paid after the liabilities, other liabilities like debt have been paid, but before equity shares, the preference shares would be paid off. So,
Another difference would be that preference shares are usually redeemable. After a fixed period of time, they are repaid back, or they may be converted into equity shares as per the policy of the companies. Whereas, until the company is liquidated, an equity shareholder money is invested into the business, it can be only traded in the financial markets, like a stock market, like a Bombay Stock Exchange or a national stock exchange.
next is how SEBI works and governing of stock market. So basically, what is the function of SEBI is SEBI is to protect the interests of the shareholders. So what SEBI does is it sees that it's a watchdog. It sees that the investors' money is not being misused. There is no case of insider trading or manipulation of the stock prices. So this is what SEBI is interested in, and this is how it looks out after the interest of stock market shareholders, invest, investors basically. And what is owner's equity? Owner's equity is the investment by owners. So we take it from here. What is buy side and sell side in investment banking? That is based on your valuation of the share. So, what happens the if according to what is buy side and sell side? Like if the company believes that that particular stock is a buy stock, like if you invest in it, you'd get a higher return. So that is the buy side, and sell side is
I would retrace this in another form. Stock market is also famously known as bulls and bears, where a bull represents that when a person expects the market price to rise, if he puts his money into the security or a share, then he is called a bull. Whereas if he expects that there is going to be a fall in market price of the share, he sells his security, then he is known as a bear.
uh, next is difference between a stock and a share. So basically, shares are also referred to as common stock. So if you see, there is no difference between a stock and a share. We have already told preferred or share.
Mhm.
Uh, we'd like to answer this question. India's currency swap agreement with other countries and effect on economy. So, like it can't be India's currency swap agreement. It has to be a company's currency swap agreement for finance related stuff, and its impact on economy won't be much.
Another question that I can see is what is liquidity? Now, liquidity here is from a business angle that how fast a business is able to convert its current assets into cash. Say cash is the most, it's called the most liquid because it it is cash itself. But bank also is liquidable because you just need a basic transaction of through a check which will convert your bank amount to cash. Things like inventory, it depends on how quick your business is able to sell that item of goods or services that is being produced and convert it into cash. Usually, for some businesses, ability of converting its inventory into cash takes a long process. It may depend on the credit policies of a company. For companies like who are into retailing and only have cash basis, they convert their inventory quickly into cash. For those companies which have credit, which sell goods on credit, it depends on the amount of time when they sell the goods and receive payment.
Next is how does a share's value vary on daily basis? The value which varies is the market value which is traded. So that is based not on the fundamentals but on the market sentiments and the news which is prevalent and how the market discounts that news. So this is how the share value changes on the daily basis.
There are a couple of things that we need to know for a share price. One is the microeconomic factors and another one is the macro factors. Micro factor relates to those which are related to the pertaining business activities. Say for example, Tata Motors. When it started its project, when it announced its project for Nano, the share prices went up. Reason, it was coming up with a new project with a product that was one of a kind and never been introduced in the world. So people actually thought that there is a positivity in this. On the flip side, if you see Satyam scam, when the Satyam scam was exposed, the share prices fell from close to 500 to rupees 6. The reason was that there was false accounting in that and there was no real value of assets in the company due to which the prices fell. Another aspect is the macro aspect. Now, these can be risks associated to politics, like change in government or any regulations, or it can have an economic side of it, which may cover interest rates, like RBI changing repo rates or any other rate. or any technological advancements may change a share price.
Uh, Also, next is difference between face value and book value. I perceive this to be face value and value of share. So basically, face value is like what is the amount mentioned in the authorized capital, like issue 1,000 shares at rupees 10 per share. So 10 would be the face value, and book value would be the intrinsic value, which accommodates for the reserves and surplus of the share. Next is what is the basic and minimum conditions to go for IPO? So that can be that is basically you should be in operations and everything. That is basically not related to finance, but the law aspect. Also, what are the changes brought by the Companies Act? Uh, Companies Act basically they changed. That was the corporate governance aspect and the legal aspect. So we are basically covering that aspect right now.
Now we would cover what is a dividend, asked by one of our uh, candidates. A dividend is a reward, it's a fixed income.
Dividend is basically what the company pays out of profits to the equity shareholders or the preference shareholders. So for the preference, it's a fixed amount, and for the equity, it varies year on year. It's a allocation of profit which is paid to the equity shareholders. Otherwise, the profits may be reinvested in the business, which would be the retained earnings. What is insider? What is insider trading basically? So insider trading is like if you are in management of the company and you hold shares and you trade on the basis of insider information, which is unpublished price sensitive information. If you trade on unpublished price sensitive information and you don't disclose it to the exchanges that you have traded like this, that is insider trading. And
Retracing this, and a management or a board of director would know what is the future course of a business, whereas any common man who invests in daily stock market will not be knowing that. So taking decisions on the basis of a knowledge that you yourself know and not the common man, that is referred to as insider trading.
And what is marking to market? Marking to market refers to how you maintain your investments actually. The trading investments are to be marked to market. Like daily, the value of your investments would change. So you change your values in your accounts. So that is marking to market. Um,
Now we would cover how important is the knowledge in finance if you want to be an entrepreneur. See, the basic knowledge of finance is required in whatever field you go. For an entrepreneur, he needs to know from where he can get funds and how can he use those funds. Also, finance, or rather accounting, a department of which may be called a subset of finance, is usually required to measure the performance of how a business is functioning. There are various levels in finance. Some are corporate finance, accounting, investment banking, which are very detailed. But for your interview purposes, you would basically be required to know some of the terminologies, common terminologies like expenses, incomes, revenues, profits, losses,
Balance sheet.
balance sheet, profit and loss account, cash flows, and some of the basic ratios which are important.
Also, there is a question which is we didn't say that if good things happen, we said that the price is sensitive to the news element. So, if the market perceives the news to be positive, the price would rise, and if the market perceives the price to be negative, the price might fall. This is to Dilip Kumar. we aren't answering the questions which are related to economics. So, like what is repo rate and everything would be answered in the webinar on economics. Where how is stock market index calculated when market closes daily? So, what happens is like stock market is basically based on the market. If you see BSE Sensex, it's the sensitivity index of the top 30 stocks on the basis of market capitalization. Which so what you do is you take the uh,
There is a value, a constant value, when BSC started actually in 1978 through an index which was 100. Today, where what you see 20,500 is from that 100 rupees increase. That 100 index is increased from 100 to 20,500 or 20,000, 21,000. Now that is calculated. There are some weights of 30 companies assigned. BSC values 30 stocks, top 30 stocks. Based on performances, previous quarters, management, etc., these 30 companies are selected. Now that constant value is multiplied with the market capitalization. But before that, we need to know there are two kinds of shares. One is with the management, and another one is floating within
free
the
float.
free float, that is with the common man and foreign institutional investors and mutual funds in the market. These securities are regularly traded. Say Wipro has 80% share holdings with Azim Premji. That is, the risk of Wipro share is only to 20% of the shares that are outside, and this 20% weight is also multiplied. Now, the sum of all these 30 companies represents the index value. If you take a share price of these 30 companies and sum them up
Weighted.
with the weighted average, then you will get the 20, then you will get the BSE index. Similarly, there is a method of NSE that accounts for 50 companies.
Yeah, there are 30 public limited.
One of the questions now that has come up is, are those 30 companies stocks of public companies?
So yes, they are of public companies which are listed on BSE. So it is according to market capitalization, which is the market price into the number of shares. So this is how it is. They are public companies.
Now we have a couple of minutes. We would be taking queries up to 2 more minutes.
Also, there is a question: to what extent does a hedge bond help in reducing losses? So, uh, actually, it depends upon what kind of hedging you are doing. So, there are many risks involved. Like there is price risk, interest risk. So, if you are suppose there's reinvestment risk. So, suppose if you are investing in a zero coupon bond to mitigate the reinvestment risk. So, a hedge bond, like I didn't understand what do you mean by hedge bond? The term isn't clear itself. Hedge funds or like hedging a bond. I Last question. It is by Ashutosh Singh. What is the significance of BSE index and how important it is? So basically, what BSE index signifies is like it has weights of all the sectors in the economy. So, like many sectors are represented, and if the index rises, it means that the economy is also rising. We expect to do well in near future, and we are doing well. And like so, this is the importance. It shows that the prices of the stock prices of the 30 companies have also risen if the BSE index rises. So, uh, and economy it reflects the situation of economy. Thank
Finally,
you.
finally, I would like to say that for those graduates who are from BCom or finance area, please brush up on your 11th, 12th basics from a book T.S. Grewal, which terminologies and the sums part or the concepts are very clearly stated. T.S. Grewal is the name of the book.
Also, there's a question: what is internal rate of return? This is the last question. So, when we are discounting our cash flows, this is related to investment. So, suppose for a project, if you want to find out that what is the return this project is giving to me, so it's basically using the concept of time value of money. So you discount using that internal rate of return, so you get a net present value of zero, which is the net present value of cash outflows minus the net present value of cash inflows minus net present value of cash outflows is zero at the internal rate of return. So this topic we haven't covered much, but this is the answer to the query.
The objective of this webinar was to introduce you to the basics of finance. We would recommend you have at least these concepts on your tips. The students of IIM Rohtak have tried to give you the best possible answers. We hope you make the most of this knowledge. All the best.